Hi guys, welcome back to part 2 of this 3-part series. In this video, we're going to go over order blocks, change state delivery, break blocks, SMT, and timeframe alignment. If you haven't watched already part 1, I suggest you go back, watch part 1 before watching this video. Okay, so let's get into order blocks, change state delivery, and breaker blocks. They all come together because they all form pretty much under the word order block. So on the screen, I have two formations. I have a bullish formation and a bearish formation. Just before we start, I want you guys to note there is two types of order blocks. There is a reversal order block, which is pretty much a change of state delivery, so a shift in the market structure. And then there is a second type of order block, which is just a supporting order block, price to be supported either higher or lower. So in the bullish example, price, let's say, is trending down into a higher time frame POI. So we have a swing low, a swing high, and a lower low, taps our higher time frame POI, and we have a sweep of sell stops. For us to signify if this is going to be a change of state delivery, we have to look at the most recent leg down that swept our sell stops or level of liquidity while also tapping a higher time frame POI, which would be this high here. We then close above this high. That signifies our first indication of a shift in the market structure from bearish to bullish. So at this point, this is when we have a bullish change in state delivery, a bullish order block that is created. Now, the second type of order block is the supporting order block. So how can you identify what a supporting order block is? Well, let's say we have a fair value gap, a PD array within here that we tap, and we now close above this high that tapped into our PD array. That then becomes our supporting order block for price to use to push off higher, which we get. So what is a breaker block? Well, simply put, a breaker block is just a failed order block. So notice here how we get this shift in market structure, right? Well, what if I was to draw this, the same price action? So we go swing low, swing high, swing low. But instead of coming up here, we came here and then just went lower. That would be a supporting order block, right? What happens here is, as I stated, we have that swing low, swing high, swing lower low, higher high formation. Well, our bullish order block, we would use the highest up close candle before the leg down that swept liquidity. If there is consecutive candles, you use the consecutive. If there's not, you don't use the highest. But in this case, it would be looking something like this. So this would be our bullish breaker block with a fair value gap aligned, also noted as a unicorn model. It's a separate entire video. I've got one on the channel, check it out. But this is in essence a unicorn model in of itself. This is a breaker block because this order block here obviously failed as we closed above here, and then it got pretty much reversed, right? And then we used it to continue off higher. So let's get into the bearish formation now that we've covered the bullish formation. So over here, it's just the opposite really. So let's say we're trending upwards to a higher time frame POI. We have a swing high, swing low, higher high that gets put in while tapping our higher time frame POI and sweeping a level of liquidity, so buy stops in this case, and then we then get displacement, a leg down that closes below the swing low that took the high time frame POI and the buy stops. So at that point in time, this becomes our change of state delivery. We get our first shift in market structure, and it's high probability again because we had that higher time frame tap and a sweep of liquidity. So this becomes again our bearish change in state delivery or bearish order block. And then again, let's say we had a fair value gap over here. Move this over to the side. We then tap this fair value gap. We would then want to see closure at the low of the up close candle that tapped this fair value gap. We get it here. So then this then becomes a supporting order block for price to tap back into and push lower. And finally, a breaker block would be, in this case, the most recent down close candles before the leg up that took liquidity, which would be, for example, here. So that would be our bearish breaker block, and this is a bearish unicorn. And as you can see, price uses it to push off lower. So that is how you combine pretty much the two types of order blocks, what change of state delivery is, and breaker blocks. So on the screen, I now have the exact same that we just went over, but pretty much in a candle formation. So let's get into it. So over here, we have a down trend that creates a swing low, a swing high, a lower low that taps our higher time frame POI. When we tap this higher time frame POI, we have a sweep of this low. So for us to identify where the bullish change in state delivery is, we would have to locate the most recent down closed candle or candles that took out this sweep. So over here, we have the highest down closed candle's body. Once we get closure above it, that is our first signature that we have a change in state delivery. And it's confirmed on this candle's body closure higher than this. So that's a bullish order block, so bullish change in state delivery. We then have here a fair value gap that we tap into. And then what happens? We get body closure above the down closed candle that tapped into it. So this candle signifies this as a supporting order block, and you could then place a order here with your stop at the low and target 2R, for example. Now, where is the breaker block? The breaker block is simply, as I stated, a bullish breaker. We use the most recent up close candle before the leg down that took liquidity, and if there is consecutive, you use the consecutive. Here we have consecutive, so this becomes our bullish breaker block. Once we get closure for a breaker block above the candles, the highest wick here, this swing high, that signifies it as a breaker block. I'm going to move over to our bearish formation. So we have an uptrend here where we have a swing high, a swing low. We then put in a higher high while tapping a higher time frame POI. We then get a sweep of liquidity here. And at this point, we then get nice displacement down where we would want to locate the most recent low of the up closed candles or candle that took the liquidity level here, for example. So our bearish change in state delivery would be this body low, gets confirmed once we close here, our change in state delivery. We then have a bearish fair value gap here that we tap into, and then its body low here of this up close candle that tapped this fair value gap gets closure here. We then get a nice tap here where you could enter there and put your target to, for example, 2R. So where is the bearish break block? Well, a bearish break block would be the most recent down closed candle or candles before the leg up that took liquidity, which would be in this case over here. This would be our bearish break block. Once you get that closure below this wick, it then signifies the bearish break block. So SMT is really simple. It's when you have two correlated pairs such as NQ and ES, and it is simply when there is a divergence or a cracking correlation between the two because they both move together. So in this example, this bullish example, we have bullish SMT at the lows. How do we have bullish SMT at the lows? Well, NQ put in a swing low, swing high, but it didn't put in a lower low. ES has a swing low, a swing high, and then a lower low. So this means that because they have that crack in correlation, signify that there is a potential reversal or that there's going to be some bullish momentum coming into the market because we also have that higher time frame area of interest tapped. Moving on to a bearish SMT, it's pretty much the same, just flipped around, right? So NQ puts in the high, low, and then it doesn't put in a higher high. ES puts in a swing high, low, and then a higher high while tapping that higher time frame POI. They're both not correlated, so there is that crack, and then that is your bearish SMT at the highs. Now, just a side note, you would usually want to short the weaker pair, and you would want to long the stronger pair. Lastly, we have time frame alignment, which is split up into 3 alignments, which is your daily bias time frame, your market structure time frame, and your entry function time frame. Before I start, I just want to say that you don't necessarily need to use the daily bias time frame. However, though, I would recommend it so you're in line with all of the time frames. But if you were to, for example, execute on the 5-minute time frame, you would want to make sure that you are in line with what the market structure on the 1 hour is doing. But without that, let's get into these 3 areas. So for the 5-minute entry function, your daily would be your bias, your 1 hour would be your market structure, and your 5-minute would be the entry function. For the 3-minute entry function, your daily bias would be the 4 hour, market structure would be the 30-minute, and obviously entry on the 3-minute, and entry on the 3-minute. Lastly, the 1-minute time frame for your entry function, your daily bias would come from the 4 hour, your market structure the 15-minute, and again, you would enter on the 1 minute. And just to wrap up, I have split these 3 time frames into 3 categories: super patient, the sweet spot, and not so patient. This is just from my experience, but I have found that the 3-minute entry time frame, that time frame alignment, for me works the best, whereas the 1 minute, yes, it can offer a lot of setups, but it's a lot of noise, and I've had a lot of losses, but I've also had a lot of wins on it. I have just found that the 3-minute for me is perfect. The 5-minute is just a little bit too long and doesn't offer as many setups that I personally would like throughout the day or throughout the week. Thank you so much, guys, for watching. That wraps up part 2 of this video. The next video is going to be part 3, where we pretty much put everything that I've just gone over together. And then we're also going to go over some extra things I'd like to talk about that potentially may help you. So if you did like the video, please leave a like, leave a comment, subscribe to the channel. And if you like as well, check out the Discord link in the description. Bye-bye, guys.